Hi, I'm David Cataford, CEO at Champion Iron. We operate an iron ore mine in the northern Quebec, one of the best mining jurisdictions in the world. We produce one of the highest grade iron ores in the world, roughly about 15 million tons per year, and have significant growth projects in the pipeline. Two avenues. One is to increase the grade of our material to become even purer so we can produce material that'll help decarbonize the steel industry. And we also have some volume growth we can discuss a little bit further, but that can significantly change the profile of the company.
Good to see you again, David. Right, it's been a while since we spoke. I think we spoke last September. And when I was doing the research for this, it struck me that some of my questions are the same as we had last time around. And that is really about $3 billion company. Have I missed the boat? Where's the growth coming from? We talked a lot about growth last time. And I'm looking at, share price from you guys this year, 2024 so far, is not delivering. What's happening out there that's affecting you? What can you control and what's out of your control?
Yeah, so when we look at maybe last time we spoke, we had just delivered our expansion that was allowing us to go from roughly about 8 million tons to 15 million tons of high-grade iron ore per year. We delivered on time, on budget, very proud of what the team has been able to do, even in difficult times such as COVID. What has been lagging a little bit is third-party logistics. They're getting their act together, but it took a little bit more time for them to ramp up. So that caused us to have to stockpile some material at site and had a bit of a slower sales portion. That should be resolved in the coming quarters, and then we'll be able to fully ship everything that we produce, recover the money from the stockpile, and be able to deliver. So I'd say that's probably one of the elements that has been lagging a little bit when you look at the market. How they view us is that we haven't profited 100% from our expansion yet. But again, that's coming in the next few quarters.
Right. When you say third party, you're talking about the rail line, are you?
Correct. The rail. The port has been operating pretty well, so it's really the rail that's been the bottleneck in terms of getting the tons down. But I mean, just to explain a little bit more on that rail, it has an 80 million ton per year capacity, and it's operating roughly at about 40 million tons right now. So the rail is not a bottleneck per se. It's really the operations that are not going that great. Not that great just because they were lacking some locos and some rail operators. Rail operators are being trained as we speak. Locos are being delivered in the next few months. So, I mean, all of that's going to get resolved. So there's no structural issues, but it's been more of an operations problem.
Right. And what else is sort of disconnecting in the marketplace? Like, you kind of introduced this phrase of green or way back. Do people get that, or they just want you to be saying high margin? I mean, what's the pushback been for you?
Yeah, I'd say a lot of things have been announced. A lot of steel manufacturers are building electric arc furnaces as we speak, but they have not been delivered yet. So we're talking about a market that's going to really unfold probably next year and the following year, because that's when all these electric arc furnaces get delivered. And if we take a little step back and discuss the electric arc furnaces, fantastic way to produce lower CO2 intensity steel. But the difficulty of that technology, making steel with electric arc furnaces, is that it requires very pure inputs, whether it's high purity scrap or high purity iron ore. And this is where we fit very well into higher margins in the future, because there's going to be a scarcity of this high purity scrap and high purity iron ore. But again, I think the hold up a little bit, people are maybe in a wait and see stance. What's very, I'd say, different when we speak to steel manufacturers is they're rushing to be able to secure this type of material, because for them, they see the scarcity. It's just maybe the market hasn't picked up on what the full potential is for that type of material.
Right. And okay, I'm going to bounce around a bit here because I'm really what I'm trying to dig at is around the economics and the margins and all of those kind of things that make me feel secure as an investor, right? So let's talk about the sales and the revenues that you announced recently. I mean, how are you doing on that front?
Yeah, so right now, if you look at the last quarter, we hit a record sales quarter, but again, we're still lagging if you look at our nameplate capacity. So we're still going to increase. And again, just to reiterate, this is more small operations. It's a question of locos and rail operators. There's nothing fundamental with the plant. We've demonstrated that the site can actually produce a run rate of 16 million tons per year above our nameplate capacity. So in terms of sales, as soon as we fix that rail portion, well, then we'll be able to sell everything that we produce. So we'll be on a run rate between 15 and 16 million tons of sales annually.
Right, and that's going to drive the economics. You'll be slightly more efficient. There'll be more margin per ton. Is that what I should expect to see?
Yeah, because if you can imagine, when we designed Bloom Lake, it didn't have a stockpiling capacity of 3 million tons of concentrate at site, because our philosophy is not to try to play the market, stockpile tons, and then be able to sell them a little bit further. So because we don't have a stockpile that's designed for that type of tonnage, we've had to move those tons around quite a lot at site, and sometimes about a kilometer and a half from the actual silos where we ship it. So that's increased cost that you see in our structure right now. And as soon as we fix the rail and we have a more fluid logistics, well, those costs are going to be out of the cost structure.
Right. So we would expect to see net income to revenue ratio improve as that rail comes on tap, and you can actually, sell more, I guess, is this what we're talking about at the end of the day?
Sell more, and also sell our operating costs will be slightly lower, so that'll allow us to have a higher margin at the same time.
Right. Okay. And look, 3 billion valuation, what do you think people are valuing you for? Because 81 million net income gives us a sort of sense of where you're at today, but what's the expectation of where you're going to need to be to potentially even backfill that 3 billion valuation and go beyond?
Yeah, when you look at where the market is potentially going and where we're going to position ourselves in it, we're going to deliver our flotation project, call it, that allows us to produce one of the highest grades material in the world. Just to give you an order example, we're bringing our grade from 66% to 69%. It doesn't seem like a big increase, but it's the game changer between selling to blast furnaces and selling to electric arc furnaces. So half of our tons will be converted, and that'll be sold at a much higher price. So that's also going to drive margins higher, and that'll be delivered in the second half of 2025.
Yeah. Okay. So 3% of practically free money. Okay. Good. In terms of your balance sheet at the moment, you're looking at what's the kind of cash debt situation at the moment?
Yeah, we're pretty much, our balance sheet is very, very robust. I mean, we're pretty much in a net cash position when you look at the debt, our working capital, and the cash that we have on hand. It is a year that we have a little bit more capex because we're delivering US $350 million expansion. So that's being invested right now. That'll be delivered second half of next calendar year. But when you look at our balance sheet, extremely robust, allows us to view not only our current growth projects, but also the future ones as well.
Right. So the kind of cash flow debt ratio, fine. The payback seems quite quick on that too. So we're looking for a sort of step change. When are we looking to end of 2025 in terms of this, meaningful addition to the margin that you are generating?
Correct. Well, we're looking at the first step change as soon as we fix that rail, because then we can increase our sales by roughly about 300,000 to 400,000 tons per quarter. So, if you sell an extra 1.5 million tons, that's gonna drive the first step change. The second one being in the second half of 2025 when we have the new product, and then either the future growth projects or the debottlenecking at our current site. So those are the two other step changes that can happen in 2026 and beyond as well.
Right, and let's look at contracting. Like you're talking about, obviously, with all these new furnaces coming online and wanting what you've got in terms of the kind of global market for product. Is it competitive out there? What's that doing in terms of driving price? And how do you tackle it when it comes to your contracting?
Yeah, if you go back when we started Bloom Lake, our main two markets were China and Japan. As we've demonstrated that we can hit high quality quarter after quarter, I mean, we're very, very stable in terms of quality. Well, then we've been able to tap into other markets like Korea, Middle East, and most importantly, Europe. So that has been the main focus for us, because the closer we sell tons to home, the lower the shipping costs for us. So that's allowed us to save on shipping, and our strategy going forward, and this is also one of the reasons why we're increasing the grade, is to be able to sell more into Europe, eventually into the US, and also more into the Middle East. So to really reduce our exposure to Asia and increase it to markets that are closer to home.
Well, let's talk about that exposure in terms of the way that you construct your contracts, because China has been fairly erratic, and a lot of metals. I know, obviously not being immune to this either, but nickel and copper, depending on what the Chinese infrastructure build out plans are or are not. You were saying that this will be a tight market, and that in terms of contracting, I guess potentially even a seller's market. Once that demand established by with the build out. So how do you go about constructing contracts in terms of the length of term, in terms of flexibility of those contracts during that term? How do you look at that?
Yeah, the main thing for us is to make sure we sell the tons to the right clients. And that means they need to have ports that can take the larger vessels, the Cape-size vessels. Because if we ship 180,000 tons in a vessel, it costs us a whole lot less than if we have to ship 2 or 3 smaller vessels. So the main initial focus is make sure we have clients that can have access to those larger berths. Second element, they need to be doing some sort of transition to make lower CO2 intensity steel. So that means they're building out electric arc furnaces. And what we've been seeing in Europe, Canada, US, also starting in the Middle East, a lot of these are being subsidized by the different governments. So even if it might not be the most economic proposition for the steel manufacturers to go down that route, they've been highly incentivized by governments to build them. So they're currently building them, and then they're going to require higher grade iron ore. So when we structure our contracts, it needs to be people that need this type of material, that will see the value in increasing their productivity, lowering their CO2 intensity, and access to those bigger berths to make sure that we're able to have the best structure in terms of pricing for our material.
But okay, thank you. But in terms of again, risk mitigation from your point of view, in terms of that kind of cash flows and forecasting of cash flows, how long are these contracts? Is it literally by the tanker or by the container ship, I should say? Or do you sign up, 2, 3, 4, 5 year contracts to deliver a certain quantity and volume? How does it work?
Yeah, it depends on the customers. So typically, it's tough to get into a steel mill because they'll make tests to make sure that the blend works for the type of steel they're going to produce. Once you've qualified and they like your material, typically you don't change your clients. So they'll, especially in the high grade space. So that being said, we typically sign contracts either yearly, either every 2 years, sometimes from 5 to 10 years. So it depends on the client and the pricing structure that we have. If it's a market that's a little bit more difficult in terms of pricing, we'll typically aim for the smaller or the shorter time frame. When it's a good market, we'll sign for a little bit longer, but we're always exposed to the spot prices. So the way that we sign our contracts, it's volume driven. So let's say you're a steel mill and you want 4 vessels next year, which will come out to roughly about 800,000 tons. Well, we'll sign a contract on 4 vessels, 1 per quarter, let's say, and the pricing will be the average of the month when the material comes to the berth. So that's high level the way that we structure the contracts. But if you look at our portfolio over the past 5, 6 years, we've added clients. We've never really removed a client. So as I mentioned, once we're in the steel mill, it's rare that we'll get it.
Okay, so you got exposure to spot price, and I guess there's a few other bells and whistles in there to protect the downside. Okay, with regards to obviously this we talked about. Okay, a step change with the rail, and obviously a more meaningful step change at the end of next year when all the big capital expenditures are done, and then it's a case of cash flowing and you being efficient in terms of capturing as much of the margin as you possibly can. What next in terms of that growth thing? Are there plans afoot? Is it more about exploration from your side and seeing how you can build this thing out? Where's the value come from?
Our view is that the market for the very high grade, that niche material, is going to grow. So today it represents about 5% of the market. But as these electric arc furnaces get delivered, we do believe there's going to be a pretty big pull in terms of this material. What's very odd when you look in the market, you've seen a tremendous amount of electric arc furnaces being announced, being built right now, but we've seen pretty much no projects of high grade iron ore. And I'm not talking about 65%, I'm talking about the 68, 69% material required for those electric arc furnaces. We've pretty much seen nothing announced. So we do believe there's going to be room to be able to grow that market. The one growth initiative that we have that makes the most sense and is the most accretive for our shareholders is to be able to debottleneck Bloom Lake. So we have two plants right now. We have pushed them harder, and we do know that they can deliver probably between 17 and 18 million tons. And as I was saying initially, our nameplate is 15 right now. So there is room for us to debottleneck, and for a marginal amount of capex compared to building out a greenfield, well, we can increase the tonnage to that circa 17 to 18 million tons. So in terms of creating value for our shareholders, the one that makes the most sense, once we've debottlenecked the rail and we've got this higher grade material, is to be able to work on increasing the volume at our current operations. In parallel, what we're working on, we have one of the best ore bodies in the world that we bought a few years ago, which is the Kami project, a few kilometers away from Bloom Lake, that can eventually produce about 9 million tons of high-grade iron ore. And when I say high-grade, it's DR grade quality for the electric arc furnaces. So that's a pretty large project, but that would allow us to produce roughly about 9 million tons of increased material. So I'd say in terms of the short, medium, and long-term growth, short is that debottlenecking that we talked about, just the rail and increase the quality. Medium term would be increasing volume with that debottlenecking, and longer term would be that new Kami project.
Okay, I kind of want to come back to onto the demand bit, and you're talking about supply, but I want to kind of talk about demand in a second. But just in terms of the share register and the makeup, obviously it's a $3 billion company. Institutions are very, very interested in this story indeed, and I think there was a big movement certainly 3 years ago with the ESG component. There's a lot of kind of greenwashing. You explained why that was not something that you subscribed to, but nevertheless, your product could be perceived as. What do you feel you need to do in terms of that share register, and what are the types of companies, institution or otherwise, that are going to be interested in what you've got? And what I'm trying to say is, I'm looking at earnings per share, or I'm looking at share growth. I'm looking at revenue margin, all of those kind of good things. The green component seems to be almost secondary now, sort of 2-3 years later. How do you view it?
Yeah, right now there's a negative view in terms of what's happening in China, and you see a lot of headlines, and pretty much the same thing every year when you look at this period. So if you go back last year in August, it was all doom and gloom. Go back 2 years ago in August, same thing. So when you look at the seasonality in terms of the iron ore price, this is typically the time where people are bearish. But if you look in the past years, well, October, November, December is when you typically see the iron ore price going back up, and then people get in a different sentiment. So there's always that seasonality, I'd say, where people maybe a little bit concerned during the summer, and then they get a bit more excited right after. When you look at the fundamentals, again, there's no new high grade that is being produced. So in terms of how we see that potentially unfolding in terms of pricing, we do feel that there is room for the margin of the high grade between the normal material to grow. Right now, we're close to historic lows in terms of that margin. And that's mainly due to the fact that there's quite a lot of negative sentiment in terms of the iron ore, in terms of China. But again, 2 days ago, we saw this new stimulus package potentially being announced. So we'll see how it goes, but very difficult to predict how China goes, even if people try every day. But typically, they haven't let that sector down for too long. So when we look at the sort of fundamentals and how we can create value, well, one, I think the pricing element is definitely one that typically gets resolved, and that allows us to have higher margins. And then, well, that's going to be at the same time as we debottleneck the logistics.
Right, and coming back to the share register makeup, as it were, is it the profile that you want? Do you want to add to it? Do you want to change it at all? I mean, the makeup of your shareholder base is really, really important. So, have you got what you want at the moment?
Yeah, I mean, one of the most important elements about our shareholder base is the fact that management and directors own just over 10% of the business. So, I mean, when an investor invests in Champion, he knows he's fully aligned, we're fully aligned with him because we've put all of our money into this. So, I mean, that portion of the share register definitely is there to stay. When you look at the other large investors that we have, having the government of Quebec as one of our major shareholders, has just over 8% of the business, is another great portion. I mean, if you look at Quebec now, it used to be the area you can get green power anytime you want. You just called Hydro-Quebec, needed to do a project, and they would deliver the power. Now, for the past 2 years, they've put a halt to that, and you need to apply for power, and they've only allocated a little few projects. And we're the only company in Quebec that has been allocated 2 lots of 25 megawatts for our current growth initiatives. So having the Quebec government as one of our major shareholders is definitely something that is important and that we want to maintain. We have another fund out of Chicago that has roughly about 8% as well. And when you look at Michael O'Keefe, our chairman, we have initial investors that followed him, a few family offices out of Australia. When you add up all those shares, roughly about 40 to 45% of the share register. The rest is split between institutions and between retail. And we have been getting quite a lot of demand and people that want to align themselves with the longer term story. But there is short-term volatility, as you've seen with this news in terms of China. So what's important for us is really to make sure we align ourselves with shareholders that see that vision, that see the potential that we have, and want to be there for the ride. Because when you look at Bloom Lake, I mean, in 2011, this was sold to Cliffs for $5 billion US. There's since been about $2.5 to $3 billion US invested in the site. So you have roughly about $7.5 billion of assets. Replacement cost is close to that as well if we were to rebuild it today. And as you mentioned initially, we're trading at roughly about $2 billion US.
Talk to me about risk mitigation. We've touched upon it, but I want to know more. You've obviously had fires up there, up at Bloom Lake, out of your control, and I think Canada's been hit for the last 3 years in various spots with that. But in terms of, and we've also seen things happening in Canada which have like totally decimated companies. Heat leach failures in Yukon, etc. A whole bunch of stuff going wrong. What are the things that you look at, that you demand from your team in terms of planning, in terms of protecting the downside, given that kind of backdrop and what it can do to companies?
Yeah, in terms of Bloom Lake, and unfortunately, you've never been up. We got to get you up to Bloom Lake. But when anybody visits the site, that's usually the first thing that people notice: the quality of the people that we have there. And people are dedicated to make this work, and it's impressive, the team that we've been able to build out. And that's helped a whole lot in all the risk mitigation portion, because we're the highest risk. Well, tailings is definitely one. So we need to make sure that we're on top of that. When you look at the way that we build tailings, we do it in a way that's a bit more costly, but we do it on one of the most stable grounds in the world. We do it with a very, very conservative slope to make sure that there's no potential failures. We have electronic piezometers and electronic detectors everywhere in the dikes, linked directly to our specialized engineers. As soon as there would be something that can happen, we have a complete protocol to be able to address it. So, I mean, we haven't left anything to chance. We've really put a lot of time and money in the past 10 years to make sure that we have one of the most robust tailings facility in the world. And where you can have a good sense that it's not just me that's saying that. When we did our expansion a few years ago, the First Nations hired experts to audit our site and to see how we do things. And the First Nations actually supported our expansion and supported our tailings expansion. So they officially sent a letter to the government to say we support Champion Iron in their expansion. I've rarely seen that from First Nation communities, but this is because their expert said this was one of the best tailings facilities he's ever seen, and he trusted in the way that we do things. So that's one element on the tailings side. You can imagine that this translates in a lot of other elements on the operations. And if you look at forest fires, I mean, last year caught us a little bit by surprise. This year, well, during the past 12 months, we hired experts. We did a full protocol on how to evacuate the site, how to protect the site, how to put everything in place. And this year, you saw there was a fire that came close to our operations. We evacuated just over 750 people in about 12 hours. We protected the whole site. We had people that were making trenches around, hosing down the different areas, and everything was put in place. And there was no impact from the forest fires that came near our site. So again, we don't leave anything to chance. We hire the best experts, and we make sure that we protect everything. And I think one of the best elements to reiterate is really the fact we own 10% of the business. So we're not going to leave these things to chance, because we want to make sure that our site is fully protected and those risks are mitigated.
Okay, so that's the physical. What about the financial? Is any sort of downside protection there, hedging, etc.?
Yeah, we don't really believe in the whole hedging portion in the iron ore space. We're a pure play high grade iron ore right now. Our investors want to be exposed to the commodity. I've rarely seen hedging work well for companies. It usually costs a whole lot of money. I can understand if we were building something for a few $1 billion and we wanted to protect some sort of downside. But we touched base on our balance sheet. We're in a net cash position. We've got a stockpile of about 3 million tons of high grade iron ore at site that has got a pretty significant value. And we've got over $400 million of liquidity available US on our revolving facility. And we've been very diligent in the way that we manage our capital. So I'd say right now our strategy is more to maximize the value when we sell our iron ore, not necessarily hedge, but really make sure we capture every dollar that we can. Work very hard on finding the best contracts for the vessels, for the sale of our material, and also don't go crazy in terms of CapEx investments and go at the right rhythm.
Which I think you said to me last time. I like that. Has there been a sort of, just before we move on to the demand bit, has there been a sort of normalization in terms of the cost base line, or is it still creeping up?
Well, when you look at the market, what's interesting is that a lot of analysts are saying iron ore price is going to sort of sub $70 per ton. In the recent years, it happened twice that the iron ore price dipped under $100, and right after it rebounded, because you see a response in terms of the supply. Cost curve has increased significantly around the world. So when you look at our region that used to be viewed as a high cost producing region, not so true anymore, because we've got the premium for the high grade, we've got potential premium for even higher, stable jurisdiction, so there's not anything sort of funky or weird that can happen. So we've got a pretty stable operations, and we're well positioned on that cost curve. So we have seen it increase, but we've seen it increase for everyone. So I don't necessarily see that as a long-term sort of potential risk.
Okay, interesting. And talking of demand, automotive sector, it's moving. We're seeing various numbers, 20% CAGR. But not as much as everyone had hoped. You know, the hopes and expectations have been met by reality, but it's still moving forward. We've seen infrastructure plays out of China, with not quite what everyone hoped, and down the list of kind of demand drivers for your green steel, not quite as everyone hoped, but it's enough. Is that what you're saying? Because the supply side is not meeting some of those demands, so it's going to be okay.
Well, if I was in the business of making low-grade iron ore to make rebar steel, I'd be concerned. Because when you read everything, you look at the potential oversupply, it can potentially be a difficult market. When you look at even China going more towards a service economy, they're going to want more flat goods. They're going to want more elements that require high quality steel. When you look at what's happening in the Middle East, there's quite a lot of investment and there's a lot of construction. And even in construction now, people are looking for higher grade type material, lower CO2 intensity materials to be able to build out. You saw at COP, the last COP, all the other ones, it was more going electric cars. Now in the last one, a lot of focus on steel and cement. So you have governments like Canada, US, UK, and Australia all saying that now when they build out material, they're going to require lower CO2 intensity steel when they build infrastructure. So everything is going towards requiring this higher grade type material. So I do feel that there's going to be some sort of disconnect between what you're typically used to as iron ore and that niche product, that sort of unique product that fits into what is being required. So I'm not saying that it's all okay for iron ore necessarily everywhere, but I'd say in the niche market that we're in, I do see some potential upside in demand.
David, it's been far too long. I'm glad to speak to you today. Nice to get the update. It kind of feels like maybe if I was doing a scorecard for the last 12 months, you've delivered on the ground, but perhaps market sentiment has been, as with everyone, fighting against you quite hard. I'm looking forward to this 12 to 18 month step changes that you're delivering. Appreciate your time today. We'll see you soon.
And one other element that I'd like to add, which I think is very pertinent and shows the implication of governance and what we want to do in the future, is that the government of Newfoundland, government of Quebec, so the two provinces that produce high-grade iron ore, have put high-grade iron ore on the list of critical minerals. So that means access to potential various funding. They have special areas to be able to go down permitting. So it's pretty impressive that we've managed to disconnect typical iron ore, high-grade iron ore, and get on the list of critical minerals. Just a few weeks ago, federal government also did the same. So Canada has now put high-purity iron ore on the list of critical minerals. So that gives potential access to infrastructure funding, access to special funds put in place to be able to help critical minerals get up and running. So it really changes the game in terms of projects like CAMI or future growth initiatives that we might have.